As the U.S. market is closed, we're looking at the closing figures from yesterday, October 28th. Plug Power Inc., ticker PLU, finished the session at $2.79. That was a significant drop of 17 cents or 5.74% for the day. In after-hours trading, there was a tiny flicker of activity with the stock ticking up less than a cent to $2.80. Many investors will see that 5.74% drop and just write it off as another day of brutal volatility for a high-growth stock, just noise in a name famous for wild swings. The expectation is that this is just what Plug Power does. But the reality is far more severe. That drop wasn't just noise, it was the sound of the market recalculating the company's odds of survival. This stock is now trading perilously close to its 52-week low. And the reason isn't just a bad day for the green sector, it's a frantic look at the company's balance sheet. The real story here isn't the daily price, it's the countdown clock on its cash. The general belief, the narrative that has captivated so many investors, is that Plug Power is the future. It's the end-to-end solution for the green hydrogen economy. We see the impressive press releases, the new plants coming online, the partnerships with giants like Amazon and Walmart for their forklifts. The expectation is that buying Plug Power is buying a piece of the next great energy transformation, much like early investors in Tesla stock felt they were buying the future of electric vehicles. But the reality, the one reflected in that $2.79 closing price, is a company in a desperate financial situation. Let's be very clear, the story is writing checks that the balance sheet simply cannot cash. The challenge for anyone holding this stock, whether in a Fidelity brokerage account or on the Robinhood app, is reconciling the grand decade-long vision with the immediate quarterly cash crisis. The latest financial reports from August for the second quarter of 2025 paint a terrifying picture. The company posted a net loss of over $227 million. That's not for a year, that's for 3 months. And while revenues did grow 21% year over year, which bulls will point to, the company's gross margin was still negative 31%. They are spending far more to produce and deliver their products than they are making from selling them. But here is the single most critical number. At the end of that quarter, Plug Power had only $140 million in cash and cash equivalents left on its books. Now compare that to its forecasted free cash outflow for the full year 2025, which is estimated to be over $520 million. The math is not complicated and it is not kind. This company is burning through its remaining cash at a rate that suggests it has months, not years, before it runs dry. This is the reality behind yesterday's 5.74% decline. This is why the stock is down so dramatically from its highs. The market is no longer just trading the story. It's pricing in the high probability of a severe financial event. This event is almost certainly going to be a massive capital raise. And when a company with a stock price under $3 needs to raise hundreds of millions of dollars, it does so by creating and selling an enormous number of new shares. This is called dilution, and it is devastating for existing shareholders as it divides the ownership of the company into many more pieces, making each existing piece worth less. This is the existential threat that is crushing the stock. It's not a matter of if they need to raise capital, but when and how badly it will hurt investors. This isn't a stable investment like Apple stock or a highly profitable chip maker like Nvidia stock. This is a binary bet on survival. This financial distress is why the stock has become a massive battleground. On one side, you have an enormous short interest. The latest data shows that nearly 30% of the company's entire float, the shares available for public trading, is being used to short the stock. This is a staggeringly high number. This means sophisticated investors, perhaps using the advanced tools on the Interactive Brokers trading platform, are placing billions of dollars in bets that the stock will go down. They have looked at the $140 million in cash and the $227 million quarterly loss and have made a cold calculation. On the other side, you have the retail investor. Data shows that retail, not institutions, is the largest shareholder group, owning over 56% of the company. These are often the true believers, the investors on platforms like SoFi Invest or Robinhood, who are holding on to that future vision. They see the short sellers as big bad funds trying to destroy a good company. But the shorts are simply reacting to the undeniable financial figures. This creates a powder keg. Any piece of news, good or bad, can send the stock flying or collapsing as these two-sided, massive bets collide. Even Wall Street analysts are running for cover. The consensus rating on Plug Power is a hold. In analyst speak, hold often means we're too nervous to say buy and too scared of the story to say sell. J.P. Morgan famously called the stock a show-me story, demanding proof that the company can fix its horrendous margins before they get optimistic. The average price target from analysts is hovering around $2, which is significantly below where the stock is even now. This isn't a case of analysts forecasting a bright future, it's a case of them acknowledging the extreme risk. This kind of stock is the polar opposite of what you'd find in a diversified, managed account like Schwab Intelligent Portfolios. Those services are built on a foundation of online investing in stable assets like Fidelity ETFs or Fidelity mutual funds. Plug Power is not that. It's a speculative instrument, a lottery ticket based on a green hydrogen dream. People using Fidelity investments for their retirement planning, building an individual brokerage account for the long term, would be wise to understand that a position in Plug is not a core holding. It's pure speculation. Now, let's briefly talk about the business itself. What does Plug Power actually do? They have built their company around the concept of a full-stack hydrogen ecosystem. This includes their GenDrive fuel cell systems, which are the engines that go into material handling equipment like forklifts. It includes Gen Fuel, which is their hydrogen fuel and the infrastructure to dispense it. And, most importantly for their future, it includes Gen Eco, which is their electrolyzer business. Electrolyzers are the machines that use electricity to split water into hydrogen and oxygen. This is the key to making green hydrogen. The company's grand plan was to build its own hydrogen production plants, especially the new flagship facility in Georgia, to stop bleeding cash on buying hydrogen from third parties. The expectation was that once this plant and others came online, their costs would plummet and those awful negative gross margins would finally turn positive. The reality? It's a mixed and dangerous bag. The good news is the Georgia plant is operational. The company recently announced it had a record month of production, hitting 97% uptime. This is the core of the bull case. They are also signing new deals, like a recent one with Edgewood Renewables to build a biofuels facility, and another to supply electrolyzers to a refinery in Portugal. This shows the technology is in demand. Their cost-cutting plan, dubbed Project Quantum Leap, aims to save $200 million and, they claim, get them to a break-even gross margin by the fourth quarter of this year. This is the lifeline that bulls are clinging to. But the reality is that even with the Georgia plant starting to ramp up, the second quarter's gross margin was still a disastrous negative 31%. This signals that the structural problems are incredibly deep, and one plant may not be enough to fix the financial hole. The company needs everything to go perfectly right now just to stop the bleeding. It doesn't have the luxury of time, and it certainly doesn't have the cash. This brings us to the future outlook, which is a landscape of starkly different possibilities. The bull case, the expectation, rests entirely on execution. In this scenario, the Georgia and Louisiana plants ramp up faster than expected. The Project Quantum Leap cost-cutting is a massive success. The company miraculously hits its target of gross margin neutrality by the end of this year. This positive news allows them to secure a large, non-dilutive loan from the Department of Energy, solving their cash crisis. The 30% short interest is trapped, and the stock squeezes violently upward, rewarding the faithful self-investing advocates who held on. This is the dream scenario. Then